when you have a strong balance sheet, you can take resources and put them towards the business rather than paying the banks. I also think that now being a public company, it'll even help us further with partnerships, consumer awareness, and attracting talent. So we're excited to have done it.
The ticket industry has got
help us further with partnerships, consumer
from the president, including others. It was an executive order. All-in pricing is now sort of the thing, and I'm curious as to how you and your customer base has adapted to that, because suddenly everybody's seeing the actual price, and perhaps they're pulling back and saying, wait a second, I can't afford that, when previously they already clicked a button and it was only later they learned, oh, wait a second, I'm paying even more. Has it resulted in a diminution in customer appetite?
Well, I think the first thing, David, is that we, StubHub, had very publicly lobbied for years to get to all-in pricing. And the reason that is that it's just a better customer experience in the long haul. So as you say, in the short term, sometimes it causes some people to drop out and not convert, but over the long haul, it's a much cleaner experience. And the great thing about having one uniform rule is that all competitors and everyone has to do it, because you can't give that experience unilaterally.
Right, but does it result then in this year being a down revenue year versus last year?
Yeah, for the first 12 months, we've seen this in states like New York that have done it, you have a drop off, and it hits about 10%.
And then what's your expectation?
Oh, then it's just back to normal. You're growing off the base because you've now normalized it. So it's just a one-time hit to conversion, resets the market, and then onward and upward you go.
I think it's important. Congratulations again. There was a transcript of a talk you gave in January. I don't want to hammer this too much, but I think the consumer is extraordinary. You said it turns out the only thing consumers like less than hidden fees are transparent fees. Now, all our lives we think, wait a second, we wish it was transparent. So that is a bit of a conundrum that I hope you can explain.
Yeah, no, I think that's right, Jim. That's what, as I was saying to David, when we lobbied for uniform law, StubHub years ago had thought about, well, we'll offer up transparent all-in pricing. But if you're the only person in the market doing it, for the reasons I said, you end up with a problem. So now that everyone's doing it, everyone's happier and you have a level playing field. So that's the idea.
Is there any way you can be the advocate of the customer in a world where another competitor owns two sides of a market, and we're a little concerned about that?
Oh, I think, again, we really, coming from what we do at StubHub, we don't have exclusive inventory. We've had to sort of work in a marketplace where every day we have to compete based on giving the best product, the best service, and customers have to like it. I think that to what you said, Jim, there's really an opportunity here to make this entire experience of buying tickets a lot easier from the get-go, because it's oftentimes not that pleasant for people.
In terms of using AI in your business and therefore enhancing the customer experience, where are you on that sort of journey, so to speak? Can we expect new tools for some of your users coming at some point?
Yeah, we're very excited about that, David. We have tremendous data that we own going back 20 years, and that helps us understand what customers may want. And it lets us present to you in a way and anticipate, oh, well, if you're a Yankees fan, maybe you want to go to a Knicks game. If you like this concert, maybe you want to go to that. And then agentically to make it easier and easier to use the product so that it's very, very simple.
When is that going to come to the fore?
I think you'll start seeing a lot of that the first half of next year.
You do? And you expect it to actually increase your growth rate?
Well, I think the great thing about AI, and I don't want to misattribute, but I think it was Alex Karp at Palantir said something to the effect of, it's phenomenal because you have a technology that allows you to provide a better experience while increasing revenue and cutting costs.
Well, it does work. It's an ontological approach, and I always salute Alex. He's a great friend of the show. That's untrue. But I do want to talk about your brand is good, and your brand is regarded as being clean, clear, easy to use. What other marketplaces could StubHub be in?
Oh, I think thanks. First of all, thanks for the compliment. Appreciate that. We worked very hard to make that possible. Thank you. I think the first thing we look at is that we want to be the destination for all live events and experiences. So consumers, they really just think of a ticket. It's not a primary ticket. It's a secondary ticket. It's just a ticket. And so for that reason, we think over time, people are just going to come to StubHub to buy any ticket. And we've already seen rights owners, people like the Yankees and Major League Baseball, who are taking those original tickets and making them available because fans trust the brand, fans are coming to us, and it's a great natural extension.
Well, and I do want to point out, I went to Wembley to see an Eagles game. You were the de facto I mean, we go to the stadium, we get the ticket, it's working, we come back, maybe we have a hot dog, we go a beer over there, and they just think you are the ticket company. Great global reach.
No, thank you. It is really great because we have a global heritage from Viagogo, and so we're able to connect people all over the world. And that's exactly what people want. They want the ticket in their language, their currency, one-stop shopping. It's what we provide, and it's just a great thing to see.
I mentioned a bit about your journey, so to speak, in terms of the founding, leaving, the sale to eBay, you going obviously to Europe and launching a new service there. What did you learn in your many years over there in terms of that you can apply here, or that you are applying generally speaking, now that you obviously not just control this global brand, but also have a public company at your that you're running?
Yeah, I think a few things. One, obviously, to go through that number of years, you have to be resilient, but you always have to be focusing on providing the best experience for the customer, and through thick and thin, and there are going to be ups and downs. I think to your question, David, about the global nature of it, and appreciate what Jim said, is that really everyone loves live events. You can live anywhere in the world. You can live in the Middle East, in Asia, in Europe. I am pretty certain that even when we get to Mars, people are going to go live events on Mars. And the fundamentals are the same as Jim said. You want to make sure you can get something easy and convenient, go in, get a hot dog, know where to go. And so creating one tech platform that we have to service all of it has been a real benefit.
Can you get me tickets to Bruno Mars at the Palo Alto Network Conference? That's the Mars I know. Now, I do want to get a sense. People are fascinated right now about the actual process of setting prices. How much were you involved with the price that we're about to get when we open?
Setting prices, meaning for the stock, as you say. Hey, as you know, Jim, you go through a process with the market. The market sets the price. We're very happy about a lot of the great investors that have come on board. And again, look, our focus is over the long haul. Build value.
Finally, Live Nation, obviously, I mean, they have a lot of control to a certain extent. Do they represent a real competitor to you at some point as they sort of potentially split and not just have primary but secondary as well?
Well, Live Nation's been in Ticketmaster's been competing in secondary for a long, long time. So they've been around doing that since 2002. So that's nothing new, and we've seen how that's played out. I think we think more broadly in terms of what I consider this primary market. We like to consider what we call direct issuance, which is, again, consumers don't care about primary, secondary. What consumers are going to hold people accountable to is, can you provide a great experience for them? Do you have an open network so they can get it where they want? And are you really great with your product and technology? We feel extremely good about the position that we are in to create a better experience for people.
Well, Eric, we wish you luck today. We'll keep an eye on how the share is open. Congrats.
Thank you so much. Appreciate you having me.
Eric Baker, CEO of StubHub. Before we head to a break, let's give you a quick look at the bond market. Of course, we've been talking about treasuries on this Fed day, where we're expected to see the Fed cut rates by at least and most likely 25 basis points. We've got a yield curve that's steepened. I mean, there's that 30-year 4.6 versus a 2-year at 3.5.
Good for a lot of companies.
Back after this. biggest laggards on the S&P so far, about 22 minutes into the trading day. You can see Uber. I would assume that is on the Lyft Waymo news, of course, starting in Nashville next year with a partnership they have. And there's NVIDIA, which we've been talking about. There's Lyft, by the way, having a very strong time. We're going to be joined by the CEO in the next hour of Squawk on the Street. Don't go anywhere.
Go with TimberTech.
Let's get to it. Stop trading with Jim.
One of my favorite companies is Micron. They do report next week. It's had a parabolic move in the last few weeks. It seems to be peaking today. I would not bet against this. Micron, Seagate, Western Digital, and Dell today. David, I think there's something going on that's very bullish about DRAM and about PCs. It's not being captured by this market. This market is overlooking it.
What is it?
It's demand. Demand's picked up for PCs.
You think so?
Yeah. Another reason, by the way, that people should be buying AMD. And AMD separating itself because, look, NVIDIA's an unbelievable company, but AMD is the winner here because nobody has said that AMD can't sell its gaming chips.
Yeah. And there it is. It did turn around after you discussed it in terms of those gaming chips. All right, what do you got on the show tonight? I know Workday CEO.
Yes, Carl Eschenbach. In the same way that you have Risher, what we're trying to bring, obviously, is the person of the day who's really moving things because it's what people want. And only CNBC has it. And I just want to point that out because it's very important.
It is important to all of us that we try and stay on top of the news.
Exactly right.
Thanks for coming in.
Of course.
Don't push yourself too hard.
I'm good. No, I'm okay, but I appreciate it.
You sound okay. All right, still to come right here. Hey, former SEC Chair Gary Gensler's going to be here.
Bringing the fireplace?
I know. I hope he brings the fireplace with him behind him. Set it up. Like the Yule log.
Right, I was going to say Channel 11. Is that still Channel 11?
We'll get his thoughts on President Trump's push to end quarterly earnings reports in addition to who knows what else. We're back in 3.
NBC Plus.
Good Wednesday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with David Faber. We are live from Post 9 of the New York Stock Exchange. Carl Candinia has the morning off. Happy Fed Day. Take a look at stocks as we kick off the morning unchanged, waiting on the big event later this afternoon. That would be the Fed, the dot plot, the press conference, and a rate cut, which is baked in by the market. The NASDAQ, it's down about 1/3%, and the Dow is slightly higher. If you look beneath the hood, consumer staples, utilities, and financials are your best performing sectors. Information technology, consumer discretionary, and communication services are lagging. As for treasuries into the Fed meeting, we've had this 10-year yield just hovering right around the 4% level. That's where we sit this morning. There's some selling at the short end with the 2-year at 3.5. We've got a great lineup ahead of today's decision. We will talk to former Fed economist Claudia Sahm. You may know her from the Sahm rule, which she created, about why the market might be disappointed by Powell's messaging today. Plus, real estate titan Willie Walker will be with us to talk about the impact of lower rates on his business. And then also, Ed, the CEO of Lyft, joins us first on CNBC as the stock jumps sharply. Look at this move, up 14% on this new partnership with autonomous driving company Waymo. But let's start on the Fed. Every Fed day.
Really? Starting on the Fed? I'm shocked.
Actually, you know what? Let's start with some news. Not
Okay,
on the
what do you
Fed.
got?
I have some news for you. It's on a new position, a personnel change. So, empty position, the number 2 role at the IMF. It's going to be filled, I'm told, according to sources, by the Chief of Staff to Secretary Bessent from the Treasury. That would be Dan Katz. He's emerged as a trusted confidant on especially international issues, and he is going to go to the IMF. I'm told the IMF is going to make a decision in the coming days on this. It's important, David, because this is the senior most position a U.S. official can hold at the IMF, according to the Bretton Woods agreement, right? Kristalina Georgieva is the European. It used to be Christine Lagarde. And now the number 2, the first deputy managing director, as it's called technically, will be now this guy, Dan Katz, who is the chief of staff. He actually led the Ukraine economic talks. He went to Kiev with the secretary. He also has been part of all 4 trade negotiations that Secretary Bessent has had with the Chinese, including the latest on TikTok. So that's an important sort of announcement and a big one in the world of IMF, World Bank,
no doubt.
international
Having known a few
economics.
people who've held that position
Ita Gopinath
through
was the
the
last.
years, it's exhausting too. So
Yes,
maybe
traveling the world.
Yeah, maybe it means it
World
gets
leaders.
to just work a little less crazy hours. All right, now
Yes, now
let's
we can
talk about the Fed.
Yeah, there you go. Okay, so every Fed day, what we do is we look at rates that affect Americans then and now. So March 2022 is when the Fed started raising rates. So we use that as a marker. The 30-year fixed mortgage, and that, remember, at that point, rates had already moved up a little bit because there was anticipation of rate hikes.
Yep.
But at that time, you could take out a 30-year mortgage for 4.3. Now we're at 6.3. The HELOC, home equity loan, the credit card rates, we always say, like, this is what matters to people and why what the Fed is doing today matters. And then I also put in the market rates, too, just to show you how different things look. With the 10-year at 4%, it was 2% back then. And then the short-term rate, which is really tied to where the Fed funds is, at 1.75, then 3.5 now. You know, the Fed's still above 4%, which would tell you that time to cut. It also just gives you a picture, David, of how, when we say restrictive, when the Fed says restrictive, this is what they mean. Right, that it's still higher rates that Americans have to pay that is holding back the economy, which is why ultimately they are set to cut today, because we're seeing some weakness in the unemployment market, and it gives them some room.
You've
to
made
make
the
it
point
easier.
many times, and others have as well, and I'm sure we'll even discuss it in the next hour. But I mean, the short end will see the impact, but there is a steepening of the yield curve right now. And we have mortgage rates lower than they've been in a handful of years, but nonetheless, the expectation, perhaps particularly in the longer end, that we're going to see a significant reduction in rates for those who want to try and buy a home?
Well, that we could. That's what happened last year when they started cutting rates. We actually saw rates move up. The only thing I would say is that this time around, we have seen this move lower in the 10-year yield just in the past few weeks or so.
Mm-hmm.
I mean, we were closer to 4.5.
That's true,
right? And we moved down to 4%.
Who was it who told
already,
you they thought we were going to get to 5? Wasn't that
before we break under 4? That was Bill Demchak.
Demchak from PNC. That was last week.
It was last week. And by the way, there's still a risk of that. Let's see what happens. Just because the Fed starts cutting, to your point, doesn't mean that market rates adjust lower, but so far they have in anticipation going in. And what's different this time than last time is the weakness in the labor market. And that's what the market has sniffed out. Now, there are all sorts of things that matter, like the fiscal position, debt dynamics, and that could keep rates high, higher inflation outlook, that could keep, the long end high. So that's definitely a risk out there to talk about.
We're still running enormous structural deficits.
Correct.
We have a national debt now, $37.5 trillion, I think, is the latest number. It's not insignificant in terms of interest costs, to your point.
So that's what could keep long end a little bit higher. Although I would say that the tariffs have been bond friendly because they are bringing in a lot of revenue. And if they continue to stick...
They've helped us. I thought it was interesting that the debate around the potential rollback of the tariffs as a result of that court ruling, and now it's going to go to the Supreme Court, the main chorus you heard from the administration was deficit reduction. It wasn't necessarily manufacturing jobs and other things. It was what this would do to our fiscal position as a result of... And
I think that's been the surprise in the markets.
Significant numbers coming in.
That's been the surprise, right? It's why bonds have been able to rally, because as inflation sort of became on the back burner and not the main worry, it was, we're bringing in a lot of revenue to Treasury coffers, and that's actually good for the deficit. But what's so fascinating about today, David, is not just what they do with rates, but the palace intrigue around the drama inside the Fed. The actual key voters, will we see dissents? Today's also one of those meetings where we're going to get the dot plot, so where Fed members expect rates to go. We could see things all over the map. Let's just look at who we're talking about, right? At the voters in the room. We never do this, but okay, Powell we know gets a vote. We pretty much know he's in the cutting camp, right? He signaled that at Jackson Hole. We're good on that. John Williams, New York Fed president, also, he spoke at the Economic Club in New York 2 weeks ago, seemed open to a cut. Michael Barr, remember him? Vice Chair of Supervision on Banking. We haven't heard from him since, in months.
Well,
we
don't know
what he's going to be.
Position, right?
Yeah, but he's still a governor, so he gets a vote.
Yep.
Don't know where he is on rates.
Bowman took that position.
Bowman took that position. She's a voter too. She dissented last time in favor of a quarter point. Will she and Waller go for a half point dissent this time? Could we actually see dissents in that direction? More voters. Susan Collins. Okay, so she spoke in Jackson Hole. She said it was too early then. That was 2 weeks ago to decide. I would guess that she was signaled some openness to a cut, that she's a cutter. Lisa Cook, we have no idea. We didn't even know if she was going to be in this meeting. Now she is, thanks to an appeals court ruling. We don't know if she's a cutter or maybe a dissenter in favor of staying. Goolsbee, who speaks a lot, feels like he was too early a few weeks ago to say whether he would cut in September. Feels like he will be paying attention to the labor market and be a cutter. Philip Jefferson, we do not know. He's the vice chair of the Fed. We haven't heard from him. For as much as these people speak, they haven't really tilted their hand as far as whether they will cut. Why? Because the jobs data was really recent.
Some of these names I know, and others I've never. Well, you know.
Yeah. Oh, and Myron. He's brand new. Will he descend
Literally
for a 50?
Got seated yesterday.
Or a 75? We don't know.
75.
That's what the president has said he wanted.
Oh, so this guy's just a pure puppet of the president?
We don't know. We don't know what he's going to do because all of our interviews in the past few weeks, he has not been allowed to say because he was awaiting Senate confirmation. Right. So all I'm saying is there's a lot of mystery. Jeffrey Schmidt might be a dissenter as well because Steve talked to him, Leisman in Jackson Hole, and he was warning about inflation risks. So maybe he's not ready to cut. All I'm saying is that
where's Waller
we could see a lot of
50?
cuts. So he dissented last time for a 25. Will he dissent for a 50?
Well, if you wanted 25 last time and didn't get it, do you now say you want 50, right?
We don't know. He hasn't indicated willingness to 50.
There's no chance we get 50 here, is there?
Market's not pricing that in, and it doesn't appear, just because the inflation risks are still out there, and they're not at their 2% mandate. They've moved up a little bit. They're not 0% that we'd see a 50 basis point cut, but it doesn't feel like that's where the Fed... They just got into the place where they would be thinking about cutting. It's exciting. This is like a big...
Sarah, I can't tell you how excited I am. Really.
When was the last time we talked about the dynamics in the Fed like this?
I'm on the edge of my seat.
Exactly. All right, let's talk more about it. Joining us is Claudia Sahm, New Century Advisors chief economist and a former Fed economist. Claudia, that will be interesting, right? We'll see who dissents. We'll see how divergent the dot plots are. What are you looking for?
Yeah, and I want to underscore that even in normal times, we would expect there to be a lot of differences of opinion. This is a very tough setup for the Fed. We still have inflation elevated. It has been above 2% for more than 4 years now. And we've had some really disconcerting numbers on jobs and what's happening in the labor market. So it's dual mandates in conflict, and that is going to bring out a lot of different opinions about what is the appropriate next step. So I think that piece of it just comes with we're in an economy that's really tough to read right now, and whichever way they move the Fed funds rate, it's going to work against one of their two goals, right? So they're picking kind of the trying to fight the greater of two evils here. So it makes it tricky, and we should expect to see these differences of opinion. Now we overlay on top of that things are not normal at the Fed right now. Right, there is a political piece to what's being pointed at the Fed that I think creates more, as you said, palace intrigue than in a typical Fed meeting where you've got the dual mandate and conflict.
Do the dissents matter? Does it matter that they're on different pages? I mean, should the market take anything from that?
I think the big question for the market today is what's the guidance? We feel fairly confident that they're going to reduce the federal funds rate by 25 basis points. In the grand scheme of things, that is not a big move in interest rates. The big move, and what has been priced in, is that this is the beginning of a pretty aggressive cutting cycle, not just this year, but on into next year. And that's the piece where listening particularly to Chair Powell as he channels where the committee is on this, like, is that what the Fed is set up for? I don't think that's what, given the risk, particularly with inflation, that the Fed is ready to kind of commit or even kind of softly commit to that path. But I don't know. I mean, it's a really tough one on merits to call, and I think we're gonna learn a lot. And the dissents may tell us something, but it's like, listen to Powell. He is the one who is going to communicate.
100%. What about your thoughts? So you're the inventor of the SOM rule, which has gotten a lot of attention, and it's based on this idea of calling recession, given what's happening with the unemployment rate, which is starting to move up a little bit. What is it telling you now?
Right. So the SOM rule, in terms of the change in the unemployment rate, we are nowhere near its historical trigger. Now, I think because we have such a reduction in immigration, we have the labor force aging, so we have this labor supply issue. So that makes the unemployment rate maybe be late to the game. So I'm not, resting easy that we're far from triggering the SOM rule. And yet I do think some of these the jobs numbers, the growth that is really slow to a crawl, I'm not as convinced that all of that we've got a recessionary setup. I think the risks are there. It is absolutely appropriate for the Fed to move and insure against some of those risks. But I also see some real risks in terms of inflation getting stuck. And we know from yet more household surveys, like the Michigan survey on Friday, people are still really feeling this. Like the inflation, even if it's not just, that much higher, it adds up over time. So I think they really do have to balance these two risks. And that means we could kind of have a stop and go in terms of adjusting policy as opposed to just running the table in terms of getting back to a neutral rate quickly.
Yeah, well, market might be disappointed if it's stop and go now that it's starting to really price in some cuts. Claudia, thank you for joining us on an important day. Claudia Sahm, good to see you. Here's our roadmap for the rest of the hour. Lyft in the fast lane this morning as the company partners with Waymo in a big push into self-driving. Lyft CEO will join us first on CNBC next.
Plus, real estate titan Willie Walker. I don't know where he came up with that one. Titan. All right, he breaks down how lower rates are impacting his business. Walker and Dunlop, of course, 30-year fix, by the way, falling to a 3-year low.
I'm going to tell him you don't think he's a titan.
You can tell him. He's going to be right here. I'll tell him.
The SEC says it's prioritizing President Trump's push to end quarterly reporting. We'll talk to former SEC Chair Gary Gensler. He's here, faced a similar proposal during his tenure. Big show still ahead. Squawk on the Street. We'll be right back.
Central American gangs like MS-13. Now, well, it's well understood that your predecessor left you an FBI infected with politics. I'm going to provide examples of that today, including making public new whistleblower records. At your nomination hearing, I made public records that whistleblowers provide me about Arctic Frost. Arctic Frost was the FBI case opened and approved by antitrust Trump FBI agent Tebow. Arctic Frost then became Jack Smith's elector case against then citizen Trump and now President Trump. These new records show that Arctic Frost was much broader than just an electoral matter. The case was expanded to Republican organizations. Some examples of the group that Ray FBI sought to place under political investigation included the Republican National Committee, Republican Attorney General's Association, and various Trump political groups. In total, 92 Republican targets, including Republican groups and Republican-linked individuals, were placed under investigative scope of Arctic Frost. On that political list was one of Charlie Kirk's groups, Turning Point USA. In other words, Arctic Frost wasn't just a case to politically investigate Trump. It was the vehicle by which partisan FBI agents and Department of Justice prosecutors could achieve their partisan ends and improperly investigate the entire Republican political apparatus. So today, Senator Johnson and I are making these records public for the entire country to see, and I hope a lot of people are interested in seeing what government can do when various agencies have a political agenda. My investigative work has also exposed the political way in which Peter Navarro was investigated and prosecuted. When FBI agent Tebow found out that Biden's DOJ would prosecute Navarro, he said, "Wow, great." That's a quote, unquote. Through whistleblowers, I've obtained a audio recording of Special Agent Giagardina and Special Agent Sebastian Gardner's delivery of a subpoena to Navarro. I'm making that audio public today. In a court document filed by the Department of Justice, Navarro's
the fleet management piece is unique to Lyft. So FlexDrive, which again we set up about a decade ago, has about 15,000 cars kind of on rent at any given point. And that kind of expertise, imagine having, thousands and thousands of cars. You have to understand where they are, when they've been last maintained, what they need to make sure that they're always available. We do that at an industry-leading level. Our cars are available about 90+% of the time, which again is industry-leading for fleet management. Again, I know it sounds kind of geeky, and when you see a self-driving car, around maybe a San Francisco or a Phoenix, you think it's just magic, that it just kind of magically takes care of itself, charges itself, and so forth. But that's not the case. So that's something that we do. We do it uniquely, and it's one of the things I think Waymo is very interested in. And then on the demand generation side, some of the other partnerships they have are of a very different type, and I'll let them speak to other partnerships that they've got. But we really like this model and think it sets us up well for not just now, but for the future.
Well, you just answered part of my question, which is, David, I get why you would want to work with Waymo. I mean, if the future of ride sharing is self-driving, but why would Waymo need a Lyft or even an Uber? Can't they just make an app and go out and do what you're doing?
So the thing is, when you think about rideshare, because you experience through the app, you think to yourself, well, this can't be that hard. But gosh, there is a lot of work that goes behind that app. Gosh, there's a lot of work. There's pricing. So again, 2 million rides a day. Every time someone opens our app, which is multiple millions beyond that, we've got to price it. We've got to estimate the ETA. We've got to make sure that the right car picks you up at the right time. We've got to do it for what we call standard, extra comfort, black, wait and save. It's quite complex. We've got to keep the car clean, or in some cases the driver does themselves. We've got to deal with customer service. All of these things is real work, and it costs, frankly, billions of dollars over the last 12, 13 years that Lyft has been doing this. So if you're a company like Waymo, sure, you might want to do some of that yourself, and they are. They're experimenting in certain markets. But I think you also want to partner with people who have been doing it for years and years and years, and I believe doing it the best in class, and figure out whether that model is maybe an even better way for you to monetize this asset, this huge amount of work you've done to create this amazing technology.
And what do investors need to know about how profitable and how much growth it's going to provide for you? Because you have turned around this company and you've been working a lot on profitability. So what does the Waymo partnership look like in terms of the economics for your business?
I'll put it in the bigger context. We've always said that customer obsession is what drives profitable growth. And that's what you've seen over the last 2.5 years or so since I've been in the seat. Customer obsession means creating great products and services that your customers want. And so I think from a growth perspective, it's only going to be positive. And then, as you say, from cost, of course, you've got lower insurance costs over time. You don't have to pay the drivers. Now, there are always trade-offs, right? There'll be other costs around maintenance and such. But we think it's going to be great for the industry because it'll grow it, but also grow it, profitably.
Is the deal exclusive? I mean, could Waymo also go to another provider, a la Uber as well, in that market?
Not in that market, we're not talking specifically about that, but no, we're really their partner in that market. Right. This is still early days, right? A lot of people are going to be doing all kinds of partnerships, and let's be clear, like this partnership with Waymo, it's a great partnership. But in other markets, they might compete with us as well. So it's sort of one of these formative times for the industry. But at least in Nashville, we're pretty much linked up together.
As you say, it is. I mean, we've talked about it for years, but it is finally here or upon us, which is autonomous vehicles on our streets, people hailing them with their apps. What are your longer-term expectations then, David, in terms of, are you going to need drivers? At what point does Lyft become a really app-only company, not including the actual people who drive the vehicles?
I don't see that happening anytime, sort of, at least in my vision, and I tend to try to look pretty long-term. Look, just think of it in a couple of ways. First of all, in any day, 9 o'clock in the morning, 5 o'clock in the evening when rush hour happens, you don't really necessarily care whether it's self-driving or not. You just want to get home or you want to get to work. And you need drivers to make sure that you've got enough capacity to do that. Think of the end of a football game or the end of a concert. Think of a time when you want help with your luggage. Think of a time when maybe you've had a rough day and you actually wouldn't mind, someone to kind of chat with a little bit. So, no, I've got actually a huge amount of optimism for that. And then I'll tell you an article I read just the other day. There are drivers now, or there are people who are doing self-driving car tours. So they're not driving the car. They're just sort of like talking you through the city of San Francisco, showing the sights. So I think there's going to be a lot of opportunity for drivers and other people who want to continue to earn money.
Interesting. I mean, I don't know. Rough day. I don't want to talk to anybody. I just, and also consumer preference would seem to indicate in many of these markets that people, if there's an opportunity to have the driverless car, they'll take it. I'm just curious, and what your own experience has been.
Well, I'll tell you something. I drive for Lyft as well. And in fact, I just did it last week again. You can look at it on LinkedIn. I sometimes post the stories. And I will tell you that when a rider gets in your car, if you tune in a little bit to what they want, often they will tell you all kinds of crazy things about their life, and they'll thank you at the end for having the conversation. So it's a funny thing that way. I'll tell you one other thing. We have this product called Lyft Ready, which we're developing, which means that a driver can buy a car, and if it's a self-driving car, and of course this is in the future, they'll be able to put it on the network just like they do today, but they won't actually have to do any driving. So I think there's going to be a lot of ways for drivers to make money. But I'll tell you what, if you get in a Lyft sometime, go ahead and have a conversation with the driver. You might find it's your best Lyft ride ever.
No, I have actually done that as well, and I use your service. So
try that, David. Try that with everybody.
Thank you.
David, really quick one to you. Not on autonomous driving, just on the core business. You reported. So I know the market wanted more in terms of revenue, but you recorded actually a pretty good quarter, double-digit bookings growth. I think record passengers. I'm wondering if you see that strength continuing now that we have seen some weakness in parts of the economy like the labor market?
You know what? We're only seeing strength in our business. And look, I talk about this all the time. There are all kinds of stories that people, like to put in their head. Here's the story of Lyft. It's the comeback story. It's the comeback story. We were such an innovative company in the early days. Then we went through some times where I think we kind of got a little bit, maybe a tiny bit off track. And now, man, quarter after quarter, record growth. And it's because we have more riders than ever because they love our service. Our drivers love our service, frankly, even more than driving on the other guys. And that just compounds. And now we're generating cash as well, over $900 million in cash. So it's a lot of fun to lead a company that's got so much potential. And now I think we're beginning to feel the real sort of it's clicking. And adding autonomous vehicles is only going to accelerate our growth.
All right. Well, we look forward to talking to you in the future as well as that growth continues. David, thank you.
Really appreciate it. It's great to catch up. Yeah, of course.
That'd be kind of fun to take a lift with him as a driver.
It would be.
After the break, I think you have to go out west to do that. Former SEC Chair Gary Gensler is here with his take on the president's push to end quarterly earnings reports, plus a read on real estate and rates. The head of commercial real estate giant Walker & Dunlop, Willie Walker, joins us at Post 9. And a front row seat to StubHub's IPO. We'll hear what the CEO said ahead of the first trade. Indications now $24.50 to $25.50. We'll be right back.
SEC Plus.
Welcome back. The SEC now saying it will prioritize President Trump's push to end quarterly reports. It's a proposal our next guest removed during his time at the SEC under the Biden administration. Joining us now, former SEC Chair Gary Gensler. Welcome. It's good to have you.
Great to be with you, Sarah. David, to be back.
So you do not agree with the president that companies should move toward reporting less frequently to think bigger and longer term?
Look, he's had this position since 2018. He's been clear, and the SEC under Paul Atkins is going to take it up, as you say. I think if the investor base, the buy side, want to keep this, they have to speak up. For me, I think transparency helps markets. If we go to only twice a year instead of 4 times a year reporting, the markets will be a bit more volatile. It will be harder to understand what's happening in the markets. And so, yes, I'm supportive of. It's worked for 55 years in the U.S. We've got the greatest capital markets.
But we don't have long-term investing. At least that is, I mean, we all know the whole period of even a mutual fund is very short, and companies are constantly complaining to me as well that I can't get a long-term shareholder base.
David, I'm going to take the other side of that.
Please.
I think that this phenomenal economy that we have is in part because of that long-term investing in the public markets and in the private markets. Look at all this spend right now, measured probably in the $200 to $300 billion a year on artificial intelligence by these big mega cap companies,
yes.
Right? They're doing that for the long term. They're not earning a bunch of profits in 2025. So I think it's an important issue, focusing on the long run, but I think the U.S. capital markets actually do that reasonably.
There's also an argument that companies aren't going public as much because there's just so much paperwork and disclosure, and the pressure around the 3-month earnings is otherwise unnecessary for them to grow and think long term, especially smaller cap companies.
Sarah, there's where I will agree somewhat with the corporate executives. There's a cost to corporate disclosure. The overall thing about corporate disclosure is it creates a big public good that the economy works and functions better. So again, the president's been clear. He's been clear since 2018 on this. Paul Atkins and the SEC will take it up. Investors and the buy side, if they say, hey, this is really important to institutional investors as well as everyday investors, and the media, if you find it really important, you need to speak up on the other side. That's how public debates happen.
And we may very well have it, and you could imagine the investors will be on one side of that debate, as you obviously say. I'm curious, Gary, your thoughts about the private markets, because we just saw a graphic. IPOs are up this year, but, I mean, the numbers are staggering in the private markets. The valuations, the ability to raise money, OpenAI, what that company's been able to do. I'm curious as to your perspective on it. It doesn't seem like that's going to change anytime soon.
I don't think so, and I think it's been one of the strengths of our U.S. capital markets that we have that lively competition between the public markets and the private markets. And we as a nation have benefited from everything that's happened from the venture capital field and the private equity field. But you do have greater transparency in the liquid markets, and thank God there are still the liquid markets at $60 to $70 trillion in the U.S. I would note our capital markets, our liquid equity markets, are 4 times bigger than all of Europe. So I'm not sure
we have one
why
company
we
whose
want to
market,
adopt.
we have one company whose market cap is larger than every market, basically, other than I think Japan. That would be NVIDIA
and China. So, but you're absolutely right. NVIDIA is larger than the entire London Stock Exchange.
But does that concern you at all? The 10 stocks, let's call it, represent 40% of the S&P?
Look, the concentration is high. Markets go up, markets go down. I'm not giving investment advice here.
You can, by the way, now.
I understand that. But there's a lot of talk about, do we have an AI bubble right now? And I think that's a worthwhile debate, and a lot of investors are looking at that. We have a market that's really been lifted up by all this buzz, and we have an economy where the investment in data centers, the investments in chips are growing so quickly that it's, some estimates it was about half of the economic growth in the first 6 months of this year is because of this one field, even if it just flattens out. And this is a whole field that right now is spending more than it's earning. Back to my point that we do long-term invest even in the big liquid markets. But what if that turns? What if all of a sudden all these AI spending?
Yeah, that's a key question investors are grappling with every day.
I just want to ask you big picture. Now that you are out of the administration and you see what the SEC under Paul Atkins is doing, they are reversing a lot of what you did and seemingly have completely opposite priorities on issues like crypto, for instance. How do you think about sort of what that means for what you were able to do at the SEC, and how are you feeling about what they're doing now?
So I'm very proud of what we accomplished. I think that the reforms we got done in the stock markets, even something is kind of plain and vanilla as shortening the settlement cycle from 2 days to 1 day and helping our markets be that much more efficient. And Europe is now chasing us and trying to do that. But for regular investors, I think we put in place reforms that I think this administration's continuing in the U.S. Treasury markets to keep them more liquid. But look, elections have consequences, and I respect our democratic forms, and naturally Chair Atkins is going to take a different approach than his predecessor, and his successor may take a different approach.
And the crypto community is ecstatic not to have you there anymore, and to have him there right now. What you did around securities and enforcement actions, and looking back on it, I mean, do you think that was the right call?
Yes, I think
because look, now we have this like burgeoning industry, and there's so much more innovation and leadership in the U.S.
and a lot more
crypto.
capital coming into it.
There may be more capital. In terms of the interest in the public is interested. I get that. But I took an oath of office. I also ran a law enforcement agency. And my predecessor, Jay Clayton, a very fine individual, ran the SEC. He's now the head of a law enforcement agency again up here in New York.
Yep.
Was bringing many cases in this field, was bringing over his tenure about 80 to 100 cases. Over my tenure, we brought about 100 cases. We were consistently trying to ensure for investor protection. And in the midst of it, we had a lot of fraudsters. Look at Sam Bankman-Fried, and he wasn't alone. And so investor protection. So when I look at the field that trades mostly on momentum, mostly on, frankly, hype for investors.
You think this is dangerous, what they're doing?
I think that for investors, everyday investors, the 5 to 10% of Americans who invest in crypto, and it's hard to get the real, but that it's a highly speculative, very risky asset. And in most of these tokens, put aside Bitcoin, but most of the other tokens are not tied to any fundamentals. And there's 5 or 10,000 of these tokens. So usually over time, you find new equilibriums. Like Warren Buffett would say, what are the goods? What are the revenues? What are they selling? And so forth.
Well, we certainly appreciate you joining us on all of these topics, and hope you'll come back.
Thank you,
Now
Sarah.
that you're at MIT.
Thank you, David.
Gary Gensler, the former chair of the SEC. Coming up, NVIDIA shares slipping this morning on news of more headwinds in China. We've got the details for you next. Plus, the head of commercial real estate giant Walker & Dunlop joins us with his take on today's Fed decision as mortgage rates now pull back to 3-year lows. And later, don't miss the CEO of Ralph Lauren here at Post 9 as the company lays out some new long-term targets. We're back in a moment. We are just over 30 minutes into the hour. Here are three big movers we're watching. NVIDIA is under pressure after a report said Chinese regulators have told the country's tech giants to stop buying AI chips from NVIDIA and to cancel existing orders. That includes a new chip custom made for the Chinese market. CEO Jensen Huang saying at a press conference this morning, I'm disappointed with what I see, but they have larger agendas to work out between China and the United States, and I'm patient about it. Meantime, British pharma giant GSK says it is pledging $30 billion toward R&D and manufacturing in the U.S. over the next 5 years. And Workday shares gaining after activist investor Elliott Management revealed a new $2 billion stake in that name. Workday CEO will be on Mad Money tonight with Jim Cramer, 6 p.m. Eastern.
All right, it's time now for a CNBC News update. Savannah now has it for us. Savannah.
Hey, David. Good morning. The former head of the Centers for Disease Control and Prevention is testifying this morning before the Senate Health Committee. Her appearance comes weeks after her firing, and she claims Health Secretary Robert F. Kennedy Jr. tried to pressure her to pre-approve vaccine recommendations from a committee that contains anti-vaccine activists. She also said he directed her to fire senior CDC officials without cause. Kennedy denies her claims. Brad Raffensperger, the Republican Georgia Secretary of State who rejected President Trump's plea to find more votes in his state after losing the 2020 election, is running for governor. Current Governor Brian Kemp is unable to run again because of term limits. Raffensperger will face off against several candidates in the Republican primary, including Georgia's lieutenant governor and state attorney general. And Uber is tapping into Kenya's $4 billion tourism market with a new option to book a safari. The ride-sharing service will allow customers to pre-book 3-hour guided tours through Nairobi National Park, which is the world's only national park located within a capital city, David.
It's interesting.
Pretty interesting,
maybe
right?
Yeah, one day maybe there'll be autonomous vehicles there. All right. Savannah, thank you. After the break, Walker and Dunlop Chairman and CEO Willie Walker right here at Post 9. We'll get his take on rates, Fannie and Freddie, of course, and the initial public offering that may be in the offing there. Don't go anywhere.
DC Plus.
All right, real estate in focus today. A lot of things are, of course, with that Fed rate cut that we're expecting in just a few hours. The rate on a 30-year mortgage did hit a 3-year low, this ahead of the Fed meeting. Walker and Dunlop Chairman and CEO Willie Walker joins us now. We'll talk, let's start on rates. Good to see you, by the way.
Nice to see you, David. Nice to see Sarah.
What is it going to mean for this 25 basis point cut, particularly for the mortgage market, given the longer end may not be moving quite as much, although Sarah pointed out the 10-year has been coming down a bit.
You have conviction that's only be 25?
I'll turn to my expert.
You think it's going to be 50?
I don't think it's. I don't think it. I just David said it with such conviction that maybe you knew something that I didn't
Just
know.
100% priced in
I
the
talked
market.
to the experts. And so
No, but David, to your point, if you look back,
I'm an expert. You're a titan, by the way.
His hair is Titan-esque.
He's just jealous of your hair.
Wow.
I got it.
Wait
this
a second.
conversation.
I can be jealous of a lot of things, but not hair.
So if you look at the 9 rate cuts since 1980 until now, those done during recessionary times tend to pull down the long end of the curve. Those done in non-recessionary times, which would be now, don't have a big impact on the long end of the curve. So who knows? The stupidest thing for me to do is try and predict where rates are going to go. But I would just say, as it relates to where mortgage rates have gone on both the single-family side as well as on the commercial side, we're in a much, much better landscape today than we have been for quite some time.
So do we think we're going to see a significant uptick overall in the housing economy?
You know, the Trump administration has been working very, very hard to get rates down, and they are going to come out with, I believe, an executive order in the next couple of weeks, really focusing on housing. Look, we have a housing crisis. We have an affordability crisis in the United States right now. And so unless we get rates coming down significantly or we get the cost of building down significantly, we're going to continue to have that imbalance as it relates to the number of people who want to live in a single-family home and the number of people who can afford a single-family home.
Okay, so you seem to be somewhat optimistic that we are going to get closer to that balance.
Look, I just saw Kramer as I was walking up here, and he said to me, you know, you're in the right space for the next couple of years as it relates to where housing is going to go and where rates are going to go. We've had, from a secular trend standpoint, basically 3 years of higher interest rates. Housing has had problems in getting both manufactured as well as absorbed. And I think that we would think that for the next several years, as rates are where they are or come down a little bit, that it will be very accommodative to the housing sector, both
and
multifamily as well as
prices come down too, because that's what we've been waiting for.
You know, the big thing there, Sarah, is that our research company Zelman has been out to all the home builders. One of the big surprises in their most recent survey is that the cost of manufacturing single-family homes has not gone up due to tariffs. Many, many people in the single-family space thought that the cost of manufacturing was going to go up due to tariffs. That has not shown up yet. And basically, there's inflation has been removed from the single-family construction as well as multifamily construction industries right now. Those numbers are kind of flat. Doesn't mean everything didn't move up in 22, 23, 24. So it's not like it's cheap to build, but we're not seeing the inflationary pressures that are going to push those costs up from here. So it's pretty good for building new supply.
Fannie and Freddie, not unimportant when it comes to the mortgage market, the housing market overall. We've reported a lot on it. I have as well. There's an IPO coming at some point, probably soon. Lutnick's out where you are, talking about the timing being near term.
Yep.
I'm curious, you know, again, no specifics, no clue in terms of the senior preferred and whether they're going to try and convert it and what exactly the IPO is going to look like and whether it's a tiny little spec. Do you have any expectations, A, for what the structure may look like, and B, what it will mean once they are no longer, or if they're no longer under conservatorship?
So a couple things are important to keep in mind there, David. The first is that Director Pulte has done a great job of getting these companies ready to go public. Okay, so as the director of FHFA, he's really focused on growing the top line, growing the bottom line, and getting these companies ready to be able to go public. And that's been very, very positive. How they come out, there are two things that Director Pulte as well as the president have continued to talk about. The first is to maximize the returns to shareholders, us, taxpayers. So try and get a number that says to all of us, the federal government stepped in, bailed them out, and we're going to get back a lot for that. So that's number one. The second one is not changing the cost of borrowing to the U.S. consumer. And if you think about those two things, what it says is that there's going to have to be either the implicit guarantee that is in place today with a really strong scaffolding that tells investors the federal government would step in troubled times, or an explicit guarantee, which would mean they'd have to go to Congress, and I don't think they go that path.
Right.
So everything that I'm hearing would say that they will take them out in some type of structure that says to investors, the federal government is still in, and that there is going to be a guarantee that makes investors not only know that this federal government will step in, but that the cost of borrowing to us as consumers won't go up.
Yep.
And as long as that stays in place, whatever structure it takes as far as an IPO, I think will be net beneficial.
Real quick, 40 seconds, but the long conversation we've had about commercial real estate, what are you hearing, what are you seeing in terms of the willingness of capital to potentially flow into that sector again?
So
Need a quick
when
answer.
we go commercial, we talk office, okay?
Yes.
There's a lot more to commercial than office,
I'm
but
glad you made
office
that
is
point.
that. And if you look at it, New York is having this massive renaissance. People are back in the office. You walk around here, there's a lot of activity. Clearly, there are concerns about the mayoral race and who the next mayor of New York is going to be. But I just had the privilege of touring the new JP Morgan headquarters last night, and it is a stunning building, and it is emblematic of people back in the office and making this city what it is.
But it's pre-Mamdani. Would you build something like that now?
I don't have the need to make that decision, Sarah, but I would say that people are looking at that with some skepticism right now, and we'll see how that plays out. But the only other thing I'd say on that is, as most people know, the mayor has a certain amount of authority, but not tons to be able to change the market that quickly. But New York is on a roll, and the one other thing I'd say to you really quickly is that so is San Francisco. There are a lot of people who've been sitting around saying, when's the moment to move into San Francisco? I continue to hear people saying there's an opportunity to step into San Francisco right now, which is very unique.
Wow, political change there brought a lot of overall change. Willie, thank you.
Thank you.
Willie Walker, Walker and Dunlap. We're back after this.
Everyone loves live events. You can live anywhere in the world. You can live in the Middle East, in Asia, in Europe. I am pretty certain that even when we get to Mars, people are going to go live events on Mars. And the fundamentals are the same as Jim said. You want to make sure you can get something easy and convenient, go in, get a hot dog, know where to go. And so creating one tech platform that we have to service all of it has been a real benefit.
All right, that was the CEO of StubHub last hour, bullish on live events in Mars. The company going public today, pricing at $23.50. Indications now pointing to higher open, $25 to $26 per share. We'll, of course, keep you posted here at the big board when that stock opens. After the break, former National Economic Council Director Gary Cohn is here on a Fed day with his expectations. Money Movers is next.
Every time.
TURMOIL.com. TurmOilSearch.com. Order filled. Order filled.
BC Plus.